Cash flow generated from operations. All right, so we're looking into cash flow statements. Now, when we look into cash flow statements, you have cash flows that are coming from different areas, actually three main areas. The first set of cash flows are coming from your business's operations, which we call as operating cash flows, which includes the cash that is coming from your trading activities, administration activities, and selling and distribution activities. Now, in addition to that, the interest payments and the income tax payments are required to be considered as operating cash flows according to IAS 7 statement of cash flows. So the cash flows that are coming from these operating activities, we call them operational cash flows. And then you will be investing money in your non-current assets. So the investments that you do in your non-current assets, it could be on a new asset, or it could be a sale of non-current assets, or maybe you could be investing on an associate or on a subsidiary, could be dividend income that you're receiving. So the investment incomes or the investment cash outflows are going to be considered as investment cash flows. Then for your operating cash flows and the investing cash flows to occur, you need to have financing. So financing can come from two sources. One is debt financing and the second one is equity financing. And when you say equity financing, that includes issue of shares. So issue of shares, what you're looking at here is actually the share proceeds that you get from a share issue. And then as a result of issuing shares to your shareholders, you need to give them a return. And the return that you're giving them is the dividend payments, which is retained earnings distributed to them. Now, the dividend payments, right, is a cash outflow as a result of funding through equity. So it is going to be considered as a financing cash outflow. Then you have debt capital or debt financing. When you look into debt financing, you could be looking into obtaining a bank loan. So if you're obtaining a bank loan, that is going to be a financing cash inflow. And then you will have to repay the bank loan. So then the repayment is going to be a financing cash outflow. But remember the interest component, that is going to be considered as a operating cash flow according to IAS 7 statement of cash flows. Now, so we looked into what are the three main types of cash flows that we have, which is operational cash flows, investing cash flows, and financing cash flows. Now, cash flow management is a very important aspect for an organization. An organization can remain to exist while making losses. But the moment the cash is gone, when the moment the organization runs out of cash, the organization goes bankrupt, right? So it's vital and important for you to manage your cash properly. You need to make sure you have sufficient cash to run your business, to do your business operations. You need to make sure your business operations are making enough cash to fund your investments. It needs to make enough cash to pay your loans, to pay your finances, right? The repayment of your finances. And you need to properly plan what is going to be your finance requirement and get the appropriate finance requirements. And you may need to decide whether you're going for short-term debt or long-term debt based on your repayment abilities, which is coming from your operating cash flows and investment related cash flows. So you need to properly manage your cash. You need to properly plan ahead about your cash flows. So the cash flow statement is used to do a proper cash management to get the information that is required for it. Now, when it comes to the format of the cash flow, this is going to be the most basic version of the format. However, this is the format of the indirect method, being your operating activities, right, for the operational cash flow calculation. There are two methods when it comes to the cash flow statement preparation. One method is called the direct method, and the next method is called the indirect method. Now, the methods are made different with the calculation of your operating cash flows. In the direct method of calculating your operating cash flows, what they do is they look into your actual cash receipts from customers, actual cash payments to your suppliers. We are looking at the actual cash flows, and then we are trying to calculate our operating cash flows. But when you look into the indirect method is going to reconcile your profit before tax into a operating cash flow. So we'll begin with the direct method, right? So we'll start by looking into this illustration here. When you look into the direct method of cash flows, right? Now, the first line that you have is you'll be looking into the cash receipts from customers. And then you will look into the cash payments to suppliers. Then you will get the cash flow from operating activities. Then you have your income tax paid. You have your interest paid. And you will have your net cash flow from operating activities. Now, let's start doing this calculation, right? Let's start preparing a cash flow using the direct method. We will be using the statement of profit or loss as the base because that is where you will be getting your incomes and expenses. The first income you see is your sales revenue. When you say sales revenue, this is the payments or cash receipts that you're getting from your customers. Now here we don't have a breakdown of cash as well as credit customers. So we'll be assuming that all of these customers are going to be credit customers. Now, the cash received from sales, my opening trade receivables. In my statement of financial position, it is 265,000, and the closing trade receivables is going to be 346,000. Now, your sales during the year, right? Your sales during the year is going to be 1,589,000. 1,589,000 is going to be the sales during the year, which means the total that you need to receive from your customers, total receivable from customers are going to be 265,000 plus 1,589,000, which is 1,854,000. Now, your closing trade receivables balance is 346. So that means the difference between this is the cash received from customers. So 1,854,000 minus 346,000, 1,508,000 is going to be the cash received from your sales or from your customers. So cash receipts from sales, that is going to be 1,508,000. Then the next component you have is your cost of sales and opening inventory. That is not a cash flow related figure. Next, you have your purchases. Now here there is going to be cash flows, which is the cash payments to your trade payables and suppliers. Now we need to see what is going to be our trade payables. Now, if you look at this question here, they are given you the current liabilities and the breakdown in an additional information. And they say trade and other. which means these payables are including your operational expenses as well, right? It's not just your purchases or your creditors included. Now we'll be calculating the cash payments for trade and other payables. The opening balance is going to be 211,360, and the closing balance is going to be 235,350. Now your purchases for the year is 1,120,000, and your operating expenses is going to be 96,000. So the total payable is going to be 211,360 plus 1,120 plus 96,000. That's going to be 1,427,360. The difference between this is the cash payments for trade and other. So 1,427,360 minus 235,350, 1,192,010 is going to be your cash payments for trade and other. So cash payments to trade and other, that is going to be 1,192,010. Right. Then the next one you have is going to be your wages and salaries. Now again, you see wages accrued. Now they don't show wages accrued and salaries accrued separately. So that means within this wages accrued, the salaries component is also included. So wages and salaries paid, the opening balance is going to be 8,640, and the closing balance is going to be 14,650. Now you have your wages coming from your cost of sales, which is 140,000. So wages from cost of goods sold, that is 140,000. And then you have your salaries of 100,000. So the salaries are going to be 100,000. So the total payable is going to be 8,540 plus 140 plus 100,000, 248,540, right? So now when you look into this, right, your total amount payable is going to be 248,540, whereas 14,650 is going to be your closing balance. So the difference between these two is going to be the cash paid as wages and salaries. So 248,540 minus 14,650, 233,890 is going to be the wages, cash paid as wages and salaries. So cash payment for wages and salaries is going to be 233,000 890. So with that, we have taken all the expenses, the operating costs and salaries were also taken in. So we can calculate our operating cash flows. Now, 1,508,000 is going to be the inflows, and your operating cash outflows are going to be 1,425,900. So your cash flow from operating activities is going to be 1,508 minus 1,425,900. So 82,100 is going to be the cash flow from your operating activities. There is no information given about taxation or interest. So my net cash flow from operating activities would be 82,100 as well. So guys, this is how you calculate your operating cash flows using the direct method, right? So this is what makes the indirect method and the direct method different from each other, right? So this is the direct method of calculating operating cash flows. The next one, you will see your test your understanding question number 1. So we put down the format for test your understanding question number 1. Let's start dealing with that question. So again, I'll be moving towards the statement of profit or loss, where I'll be basing all my calculations. Now there is a note that is given to us at 30th September 2008. Flute had agreed to, but not yet accounted for, a contract between trade receivables and trade payables amounting to 230. So there is going to be a set off between your trade receivables and trade payables. So this basically means your trade receivable closing balance and your trade payable balance is going to be changed. So your closing balance on your trade receivables is 31,280. Sorry, 31,250. And the closing balance of your trade payables is going to be 14,195. So when you have a contra or a set off, your trade receivables are going to decrease. So your trade receivables will decrease by 230, and your trade payables, you'll have a contra and it will decrease by 230. So the closing balance is going to be 31,250 minus 230, which is going to be 31,020, and trade payables is going to be 14,195 minus 230, that will be 13,965. So we have sorted out that adjustment here. Now to the sales. My sales is 427,915. So this is to calculate the cash received from customers. Now my opening trade receivables is going to be 35,633, and my sales for the year is going to be 427,915. So the total receivable from receivables is going to be 35,633 plus 427,915. That's 463,548. Your closing balance is going to be 31,020. So the difference between this is going to be your cash receipts from customers. So 463,548 minus 31,020, 432,528 is going to be your cash receipts from customers. So cash received from sales, that is going to be 432,528. Right. Now, the next one is going to be your purchases. So that is cash paid for your trade payables. Now, your opening trade payables is going to be 13,750. Your purchases is going to be 165,000. So the total payable is 13,750, the opening balance, plus this year's purchases, 165,000. 178,750 is going to be the total of payables. So your closing payable balance is going to be 13,965 after the adjustment. So cash paid to suppliers is going to be 178,750 minus 13,965. That will be 164,785. So cash paid to trade payables is 164,785. The next one you have is your wages. So wages paid, the opening balance of your wages is going to be 835. Your wages for the year is 52,750. So total payable is 835 plus 52,750. That's 53,585. Now from this, you need to reduce the closing balance, your closing wages, which is going to be 1,015. So cash paid to employees as wages would be 53,585 minus 1,015. That will be 52,570. So cash paid to employees is going to be 52,570. Next, you have your interest expense. So you need to calculate your interest paid. Your opening payable balance on interest is going to be 300. Your closing balance is going to be 350. The amount coming from your SOPL, the expense for the year, is 325. So the total payable is going to be 625. So the difference between this is going to be the cash paid as interest. The 625 minus 350, that will be 275. So your interest paid is going to be 275. Next is you have your income tax charge. So your income tax paid, the opening payable balance is 1075. Your income tax expense for the year is going to be 1515. Total payable will be 1075 plus 1515, 2590. Your closing income tax payable is going to be 1250. So cash paid as income tax is going to be 2590 minus 1250. That's 1340. So we are paid 1340 as income tax. We're done with all the adjustments. Now we can finalize this. The total outflows is going to be 217,355. So your cash flow from operations is 432,528 minus 217,355. Will be 215,173. Total cash outflows from income tax and interest is 1615. So your net cash flow is 215,000 minus 1615, 213,558. So that's going to be your answer for test your understanding question number 1. The next one is where we'll be looking into the indirect method of calculating the operating cash flows. Now, in the indirect method of calculating the operating cash flows, now what we're doing is we are going to arrive from my profit before tax to my operating cash flows. So to my profit before tax, what I'll do is I'll be adding, right? I'll add my finance cost. So I will arrive at the operating profit, right? So if you look at your statement of profit or loss, right? So in your statement of profit or loss, you have your operating profit. And from your operating profit, you will be reducing your finance cost. So when you reduce your finance cost from your operating profit, you will arrive at your profit before tax. So that will be 700,000. So what I've done is I basically turned this upside down, right? I wanted to arrive at my operating profit, so I can convert my operating profit into operating cash flows. Now, when you do this conversion, right, there are a few adjustments that we will be doing. First thing that we're going to focus about is within this operating profit, there are non-cash transactions. Now, when you say non-cash transactions, for an example, you have depreciation. Right now, depreciation is an allocation of the cost of the asset over the useful economic life. Right? So this has nothing to do with cash. We're not going to be paying any cash here. Right? It's just an accounting adjustment according to IAS 16. So if I add my gross profit, and if I add depreciation coming in, 30,000. Then my operating profit would be 200,000. Now, if I need to remove this depreciation, right? If I remove this depreciation, if I remove an expense, then the profit is going to increase, right? When an expense is removed, the profit is increased, right? So that means when you remove the depreciation, your profit has to increase. So the depreciation charge will be added to your operating cash flow. The next one you have is, let's say, a loss on disposal. Before a loss on disposal, let's say a loss on disposal. Next thing we have is a loss on disposal. So loss on disposal is also an expense. Now, if you look at a disposal of an asset, you will have your selling price less the carrying value to get you the profit or loss on disposal. So if the selling price was 140,000 and the carrying value was 160,000, then you would make a loss of 20,000. This loss of 20,000 is what you're going to show in your SOPL under operating losses, right? So you need to remove this value of 20,000 because this is not the cash figure. The cash figure is going to be the cash proceeds of 140,000. So I'll be removing this loss on disposal. So the loss on disposal is an expense. So when you remove an expense, your profit is going to increase. So the loss on disposal would get added. The next you could see a provision for court case. So a provision for court case, that is also an expense. So it is a non-cash item. So when you remove a non-cash expense, your profit is going to increase. So you add it. Then you would see a profit on disposal. Now, profit on disposal means it's an income, right? So if you had a gross profit of 230,000 and a profit on disposal of 20,000, then your operating profit would increase to 250,000 because it's an income. So when you remove an income, what happens is your operating profit will decrease. So when an income is removed, the profit will decrease. So if there is going to be a profit on disposal, you will decrease, right? So in summary, guys, a non-cash expense are going to be added and your non-cash incomes are going to be removed. Okay. And then the next component here, what you have is your working capital adjustments. Now, when you say working capital adjustments, it includes your current assets and current liabilities. So your current assets could increase or your current assets could decrease. Now, when you look at your current assets, for an example, if I look at inventory, if my opening balance of inventory is 120,000 and my closing balance of inventory is going to be 130,000. That means my inventory has increased by 10,000. If my inventory has increased by 10,000, This means I have spent more money on acquiring inventory. So this will be treated as a cash outflow, right? So an increase in a current asset is going to be treated as a cash outflow, right? Because we have spent money on investing on that current asset. Then if you look at your receivables, if you have an opening balance of receivables of 130,000 and a closing balance of receivables of 100,000, that means your receivables have decreased now. So you will have a decrease in receivables of around 30,000. So that means you have received more money, right? You have received more cash, resulting a decrease in receivables. So then if your current assets are decreasing, that means you are converting or you're liquidating your current assets. So that will be taken as a cash inflow. Next, you have your current liabilities. So you will have an increase in current liabilities and decrease in current liabilities. So let's look into some of the workings. Now, let's say you have payables. So if you have an opening balance of payables, right, which is going to be 230,000, and if you have a closing balance of 260,000, that means you have an increase in your payables of 30,000. So if your payables are increasing, means you are not paying your suppliers. So if you are not paying your suppliers, you are saving money, right? Which means this is treated a cash inflow. So if there's going to be an increase in current liabilities, that means you're saving money. So it will be treated as a cash inflow. On the other hand, when you look at your payables, if you had an opening balance of 270,000 and a closing balance of 240,000, that means you have been paying more, right? Your trade payables are decreasing. So your trade payables are decreasing by 30,000, which means you are paying more. So if you are paying more, right, you are basically spending money, right? You are settling the money, or you are giving your money, or you are paying your money to your suppliers. So this will be treated as a cash outflow, right? So if there is a decrease in your current liabilities, that will be taken as a cash outflow. After these adjustments, you will end up with the cash flow from operating activities. Then you have your income tax paid as normal, then interest paid, and you will have your net cash flow from operations. So this is going to be the calculation of your operating cash flows using the indirect method. So we'll look into a question and learn about this. So what I normally do is I put down the formats beforehand. So here I have the net profit, which is profit before tax. Then you have the finance cost. Then you get your operating profit. Leave some lines for your non-cash adjustment. Then you have your working capital adjustments. Then you get your cash flow from operating activities. Then you have income tax paid, interest paid, net cash flow from operating activities. Then you have your investing activities and financing activities. Now, your profit before tax given to you in the question is 250, which is your net profit. They are not given you any information about the interest separately, so your finance cost will be 0 and your operating profit will also be 250. So one thing they say is that there's a depreciation of 255, which is a non-cash transaction. So depreciation is an expense. So a non-cash expense, you add it back. So depreciation of 255 will be added back. Your net profit is 250, then you have dividends declared and paid during there, which is 80. So under financing activities, you have dividends paid, which is going to be a net cash outflow of 80, right? Because dividends are paid as a result of issuing shares. So it's a financing activity, a financing cash outflow. Now, normally before you move ahead, you need to look into the notes that are given. During the year ended 30th June 2006, non-current asset which had cost 230,000 was sold for 145,000. The loss on this disposal has been included in trading expenses in the statement of profit or loss. Now this, I will need to open up a IAS 16 property, plant and equipment working. Now I need to see whether the figures are given to us in cost or net book value. Now in this question, it is given to us in cost. So there's going to be two sections on this working. One section to calculate the cost, the other section to calculate the accumulated depreciation. Now the cost, the opening balance is going to be 3,000. Now they said that there is going to be a disposal coming in. So the value of the asset that was disposed is going to be 230. So if you are having a disposal, that means your asset value is decreasing. So by 230, your asset will decrease. Now your opening balance of accumulated depreciation, that is going to be 2,100, and your closing balance on accumulated depreciation is going to be 2,300. Now in the question, they said that our depreciation for the year is going to be 255. So when you charge depreciation for the year, your depreciation or accumulated depreciation will increase, right? So the balance should have been 2,100 plus 255, 2,355. Now, when we dispose an asset or when you revalue an asset, right? In both situations, the accumulated depreciation is removed. So here we have a disposal. So we'll be removing the accumulated depreciation. So disposal of non-current asset, the accumulated depreciation is going to be 55. So then you get the balance of 2,300. Now you know what is the cost and the accumulated depreciation of the asset. So you can calculate the carrying value of the asset disposed. The cost is 230. Accumulated depreciation is going to be 55. So the net book value of this asset is going to be 230 minus 55, 175. Now we need to see the profit or loss on disposal. So it's the selling price minus, or the sales proceeds minus the carrying value. So the sales proceeds from this asset is 145,000. So from this you need to remove the carrying value, which is 175,000. So you have a loss on disposal, which is going to be 145 minus 175, that's 30,000. So loss on disposal is included within your trading expenses. So this is a non-cash expense. So the loss on disposal needs to be added back, right? So if you're removing a profit expense, right, your profit is increasing, so you will be adding the loss on disposal, which is 30,000. Trading expenses include a provision of 70,000 for a court case. So this is again a non-cash item, right? So provision for court case, that is going to be 70,000 cash. We will be adding it back, as since it's a non-cash expense, so then your profit will increase. And this provision is included within the payables. So that means your closing payables needs to be adjusted to remove this provision. So the closing balance of your payables is 4,430. From this, you need to remove the provision, which is going to be 70. So your closing trade payables will be 4,430 minus 70, which is 4,360. The payables without your provision. Right. Now the adjustments are done. We have taken all the notes, so we can finish up this IAS 16 working so that we can calculate the investment that we have done in our non-current assets. Now the closing balance of my property, plant and equipment is going to be 3,500. So 3,500 is my closing balance. Now, after this disposal, the balance of my assets has to be 2,770. So the difference between this is going to be my investment in non-current asset. So 3,500 minus 2,770, 730 is going to be my investment in the non-current assets. So I'll show the investment in non-current assets, 730, and the proceeds from the disposal, 145, right? The cash proceeds, which needs to be shown in your statement of cash flows, right? Next, We will have our working capital adjustments coming in. So we will have our opening, sorry, and closing balances. So to begin with, I have inventories. My inventory opening balance 2000 x 5. That is going to be 825. Closing balance is 1175. So I will have an increase of 350. And then my receivables, the opening balance is 5200. The closing balance is 5065. So 5065 minus 5200, your receivables are decreasing by 135. Now your bank and cash is actually used at the very end of your financial statement of cash flows. You have your opening cash balance, which is going to be 2350. So if my cash flow statement is correct, I should end up with the balance of 2160 as my closing cash and cash equivalent balance. Next, you have your capital and reserves. So you see your ordinary share capital has increased by 400 and your share premium also has increased by 400. So total receipts from share issue. So your share capital has increased by 400. Share premium has increased by 400. So the total proceeds will be 800. So under financing activities, you will have the proceeds from share issue, which is going to be 800. Then your retained earnings, this is more of a cross check at this situation. This is to see your dividend payments. So the opening balance of your retained earnings is 1400. Your net profit for the year was 250. So your total retained earnings should be 1400 plus 250. But your closing balance is 1570. So the difference is going to be the dividends paid, which is 1650 minus 1570, that is 80, which is the exact amount that we got as the dividend paid here. Now my current liabilities is going to be my payables. So I have my payables. The opening balance of my payables is 4,000, sorry. The opening balance of my payables is 5,075. Now there was an adjustment coming for my payables, which came from my provision. So now my closing payables is 4,360. So when you look at it, there is going to be a decrease in your payables by 715. Now, if there is going to be an increase in inventory, that means you have spent more money on your inventory. So this would be treated as a cash outflow. So under your working capital adjustments, increase in inventory, which will be treated as a cash outflow of 350. The next one, you have receivables. Your receivables have decreased by 135. So that means you have received more money from your receivables. So that will be treated as a cash inflow. So decrease in receivables, 135, a cash inflow. And when you look at your payables have decreased. That means you have paid more to your payables. So that would be treated as a cash outflow. Yeah. So there's a cash outflow of 715. So decrease in payables, cash outflow 715. Right. So with that, we are done with the working capital as well as extracting figures from my statement of financial position. So now it's a matter of finishing this up. So your non-cash expenses would add up to 355. So 250 plus 355, that's 605. Your working capital adjustments will add up to 930. So your cash flow from operations is 605 minus 930. That will be 325. Income tax and interest is not given in this question, so 0, which means 325 is going to be your net cash flow from operating activities as well, a cash outflow of 325. So when you look at your investing activities, your investments in non-current assets 730, proceeds from the disposal is 145. So you have a net cash outflow of 585. And you will have a net cash inflow from financing activities of 720. So your cash flow for the year is minus 325 minus 585 plus 720 to be 190. So 190 minus 190 plus 350, that's 160, just exactly your closing balance that was given to you in your financial statement of financial position, 160, right? So this is how you prepare a statement of cash flow in the indirect method. And this will be the answer for your first, so question number 2. Yeah. So let's look into question number 3. Question number 3. AMS Co made a gross profit of 239,000 in year to 31st August 2008. So if you look at this question here, the statement of profit and loss is not given to us. So if you look at this question, the statement of profit or loss is not given to us. So AMS Co made a gross profit of 239,000 in the year to 31st August 2008. So let's recreate the statement of profit or loss. So the gross profit is 239,000. Expenses amounted to 159. Which included an interest of 30,000. So within these expenses, there is an interest of 30,000 on a long-term loan and depreciation of 50 to the plant and depreciation to premises, which is going to be 25,000. So 75,000 in total, right? So be 75,000 in total. Income tax in profit or loss was 10,000 and the dividend paid for the year was 45,000. So the income tax of this organization is going to be 10,000 and the dividend paid is going to be 45,000. Right. So your net profit will be 239 minus 159, which is 80,000, right? So let's put down the format for our statement of cash flow. We'll be beginning with the profit before tax. We'll have our interest paid and you'll have your operating profit. Leave some room for your non-cash transactions. Then you have your working capital adjustments. Then you have your cash flow from operating activities. And you have your income tax paid, your interest paid, and you will have your net cash flow from operations. So you will have your investing activities and financing activities. You will have your opening cash and cash equivalents. Then your closing cash and cash equivalents. Right. So let's begin. During the year ended 31st August 2008, plant which had cost 85,000 was sold at a loss of 10,000. The sales proceeds were 50,000. So the sales proceeds were 50,000. We have had a loss of 10,000. So the net book value of the asset should have been 60,000 if you had a loss of 10,000. The loss was recognized in profit or loss as a part of your expenses. Now the cost of this asset was supposed to be 85,000. So your accumulated depreciation on this asset to have a net book value of 60,000 should have been 15,000. Is it 85 minus 60 should have been 25,000. All right. Now the sales proceeds of 50,000 has to be shown under investing activities. So proceeds from disposal is going to be 50. Then you have your loss from operating, so loss from disposal, which is a non-cash expense, needs to be added back to your profits. Loss on disposal, that is going to be 10,000. And then you will have your IAS 16 working coming in. So here you see there is a little bit of a difference. There is no accumulated depreciation given. So this IAS 16 working, we will be doing it based on the net book value, right? They have already given us the net book value. So all the calculations we do is going to be based on net book value. So the opening net book value is going to be 1,170 for premises. There are two assets, premises and plant. So premises opening balance 1,170, plant opening balance is going to be 700. The closing balance for premises, it's going to be 1,200, and for plant, it would be 800. Now the disposal is going to be a plant. A plant is what you are going to be disposing. So you will have a disposal coming in, which is a plant which had a net book value of 60, right? So you will be using the net book value for these calculations. In addition, they had given us the depreciation information. So the depreciation for the plant was 50, which will reduce your net book value. And the depreciation for your premises is 25, which will reduce your net book value again. Right? When you charge depreciation, your net book value will decrease. So when you look at the IAS 16 working, 1,170 minus 25, your balance should be 1,145. 700 minus 60 minus 50, that will be 590. So the differences would be the investment in non-current assets. So 1,200 minus 1,145, 55 on premises. 800 minus 590, 210 on your plant. So altogether 265. So investment in non-current assets would be 255. So we are done with that working. Let's finish up these workings around here. So your profit before tax is going to be 80,000 coming from your first para. There is going to be an interest of 30,000. So you add it. So your operating profit will be 80,000 plus 30,000, 110. Then you have your depreciation needs to be added back. So depreciation and non-cash expense altogether, that is going to be 75,000. Then you have your income tax, which is 10,000, which we'll need to use for our income tax paid calculation. Now, let's go to our current liabilities. You will see income tax. So the opening balance of your income tax is going to be 12. Your closing balance of your income tax is going to be 10. So your income tax for the year is going to be 10,000. So that means the total amount payable should be 22. So if you have a closing balance of 22, the amount paid is going to be 22 minus 10, which is 12. So the income tax paid would be 12. The next information is about the interest. So now the interest, you don't have a opening liability, right? There is no opening amount given us to you, right? Or a liability or an accrued amount. So we'll have to assume that the entire interest has been paid. So the interest expense was 30. So that entire expense of 30 would be paid. So there would be a cash outflow of 30 in terms of the interest. The next is the dividend, which is under financing activities, where your dividend paid, which is going to be 45,000. So all this information around here is taken. So let's go to the statement of financial position. Non-current asset information was taken, your current assets. This is related to your working capital. Your working capital adjustments. The opening, closing, the change. So you have inventory coming in. So your inventory closing is 450. Opening is 550. So you will see a change, a minus 100. So if your inventory is decreasing, that means you have liquidated your inventory. That is going to be a cash inflow. So decrease in inventory of 100 is going to be taken as a cash inflow. Then you have your receivables. The closing balance is 700. The closing balance is going to be 700. The opening balance is going to be 680. So if you look at it, your receivables have increased. That means you have received less from your receivables. So that is a cash outflow. So increase in receivables is going to be 20, which is going to be treated as a cash outflow. Bank and cash. So your opening cash balance seems to be a negative balance. There is no figure here, but your closing balance is supposed to be 300, right? So your closing cash balance is supposed to be 300 if everything goes right. Now your ordinary share capital from 1,300, it has come up to 1,800. So issue of shares. You have the share capital increasing by 500. Then you have the share premium. Your share premium from 300 to 400, it has increased by 100. So total proceeds from the share issue is going to be 600. So under financing activities, proceeds from share issue, you will have a cash inflow of 600. Your retained earnings. The opening balance of your retained earnings is going to be 367. The profit for the year was 80. Sorry, your profit for the year 80 minus 10. Your profit after tax is going to be 70, right? The 80 was your profit before tax. So from that, you need to remove the income tax of 10. So it will be 70. So your retained earnings has to be 367 plus 70, that is 437. The closing balance of your retained earnings is going to be 392. So the difference is going to be the dividend paid, which is 45, and that's the exact amount given to us in the question. So the information tallies. Then you have your non-current liabilities, which is your loan notes. So your loan notes have decreased. So under financing activities, repayment of loan notes, that is going to be 200. By 200, your loan notes are decreased. Then your payables under your working capital adjustments. The opening balance of your payables is 681. And the closing balance is 648. So the change, your payables have decreased. That means you are paid more. So you have paid 33 extra. So that is a cash outflow. So a decrease in trade payables is going to be 33. Income tax was already taken, so your bank overdraft, so you have a negative balance of 40 as your opening cash balance. Right. So all the information is taken. Now it's just a matter of finishing this off. Oops. Get them into thousands, 80, 30, 110, and 75. So the total of your non-cash items would be 85. They would add up to 110 plus 85, 195. Your working capital adjustments will add up to 47. So your cash flow from operations will be 195 plus 47, 242. From this, your total of income tax and interest paid is going to be 42. So your net cash flow is going to be 200 and is going to be 200. So your proceeds from the disposal, 50 plus minus 265. So it's a net cash outflow coming from your investing activities of 215. From your financing activities, we have a net cash inflow coming in of 355. So our net cash flow is going to be 200 minus 215 plus 345. So 355, that will be 340. So 340, which is a cash inflow, added to the minus figure of 40, your closing balance has to be 300. So it tallies up. So that means our statement is correct. So this is going to be the answer for question number 3. So guys, this is the end of the chapter of statement of cash flows. Okay.